where we think gold is now entering what would be the final stage of its now 8-year-old bull market, meaning the phase where the dynamics of the market is no longer this arm wrestling process, but it's far more vertical, far more dynamic.
This is sort of the moment in the interview where I get you to tell me that gold is going to 10,000 so I can put it in the headline and get a bunch of views.
If I were going to be in energy, I'd be in the uranium-related stocks, which is URA. It's an ETF. So I think commodities will participate in the next up move in gold. But I still think the grains are a slingshot situation, whereas energy's not so much of a slingshot anymore. Yes, uranium might go further, but I think it's the core foods, the grains, that have the most dynamic in terms of percent gain.
All right, Michael. Well, thanks for being here. Of course, you don't need an introduction, of course, though. So let's not lose any of your time on small talks. And it's actually a very fitting day to talk to you specifically because you like charts and you like gold too. And so looking at the gold chart, it's kind of surprised me as to what's been happening recently. It spiked to a new all-time high, I believe, today, over $2,100, and then back down to a little over 2,000, which has happened a lot recently. The gold being pulled back to that $2,000 range. So talk to me about that. What's happening with gold today?
Well, the context, investment grade context here. Okay, gold began its bull trend by our metrics. No, we look at price, but secondarily, we take price and we convert it to momentum charts. So we end up with oscillators where we see price plotted in relation to a given, usually long-term moving average. It's either above it or below it, but you create an oscillator. You don't just overlay the, like most people do. There's a moving average overlaid on price. It's next to meaningless noise. Anyway, by our metrics, in February of 2016, gold was coming up from the low, bear low, in 2015, December, at around 1,050. When it got up to 1140, we pushed the button. We had been bearish since 2012, by the way. Gold made its high in 2011. So we do change. But we turned bullish in February 2016, but that was at $1,140. Okay. If you go back and look at the history of gold bull markets since it basically was legalized in the 70s, you had a move that took it from its fixed price levels in the 30s, that'd be in the early to mid 1970s. By 1980, 10 years later, it was $850. So quite a gain. There were some what you call bear trends in between. And then in 2000 to 2001, it based out at around 250 and went to 1920 over the next 10 years. If you look at those bull trends, even just on a price chart, you'll see that most of the percentage gain that came in those bull trends came in the last year or the last several quarters of the multi-year bull trend. It wasn't evenly spaced. In other words, you had, arm wrestling match for 7-8 years, and then suddenly, boom, gold doubles. And at that time, silver triples or quadruples in those final phases. Well, okay, ours began in late 2015 at a low. Okay, it's now been 8 full years since that bear low, and gold has doubled in an arduous manner. In other words, you've had declines that make everybody think the end of the world's coming for gold, but we still persist. Well, between 2020, when gold traded up to $2,080, multiple hits since then have peaked in that same general area. March 2022, we get up to 2,080. Early this year, we got up there again, and then they smacked it down to 1,800 something. And then we blew through it finally. Now the price guys, what you're talking about here is very emotional for them. They see this flat ceiling below 2,100, above 2,050, but below 2,100. Gets up there, fails, gets up there, fails, gets up there, fails, but it really doesn't fail. It just pulls back. And now you blew through. And so now all the price guys, late to the game, we argue, suddenly, oh boy, a breakout. Well, we don't trust price chart breakouts unless they're pre-validated by momentum. In other words, if a momentum action of a market breaks through let's say, a resistance structure overhead, like a ceiling, and then price later breaks out, we say, oh, okay, price has been pre-validated or concurred with by momentum. But quite a few times in price chart analysis, you'll get a quote breakout that every guy with a crayon and a ruler can plot on a price chart. It might be downside breakout or upside breakout, but momentum doesn't agree with it, in which case probably what you're looking at is a bear trap or a bull trap on the price chart. During the bull market since the 2016 buy signal, there have been many pullbacks, and we've called the upturns from the pullbacks when there was the resumption of the ongoing trend. Well, when we got down to 1830s in early October, when it got up to about 1860 and change, just a few weeks off the low, we put out our first buy signal again, meaning a lesser time scale, not the big picture. The big picture turned bullish in 2016. Nothing's changed that, period. Okay. But these corrections, we analyzed them. And momentum said to us in 1860s, price-wise, first week in October, a couple of months ago. And when it got up in the high 1920s, buy it back. It's going up. In other words, it's going to resume its ongoing bull trend. That what we've seen since early this year, which was again up to that 2050 plus level, you got your arduous 6-7 month pullback, overlapping, constant nightmare for the bulls. That is, if they got in long and got in late. Then we signaled the upturn in low 1900s, second week of October. Well, gold then exploded back over 2000 again. But again, it couldn't take out that 2100 level. So again, for the fourth time, the price chart guy said, sell it again, sell it again. Well, this has gotten to be ridiculous to look at a price chart. This is crew cut, like you've never seen in the history of gold, where it hits a level, hits a level, hits a level, hits a level, the same price level, and the price guys come in and sell it again, thinking the end of the world's coming for gold. Well, we blew through it. But our momentum said buy it 1860s, 1920s in October, not when it took out the 2100 level. Now, price guys joined in then. Of course, they're buying already what was a short-term overbought market because you'd had a heck of a run to get there. And we gushed up to 2150 last night. Well, in the dark, one, the futures are fairly illiquid at that point in time. You no doubt had a lot of buy stops elected. Buy stops meaning the folks who either wanted to get long at that point, finally believed it, latecomers, we call them, because they're using price charts, or they were already short, and that was their stop out point, which case they took huge losses probably. But there was this gush of buy stops, therefore. And so you had a run from 2100 to 2150 in a heartbeat. And once that buying wave sort of subsided during the night, you pull back. And everybody thinks, oh, it's failed. Well, we wouldn't believe the price chart breakout had momentum not already at much lower levels broken out ahead of time. So we do trust the price chart breakout. What you're seeing now is simply the volatility that you're going to get probably over the next year, where we think gold is now entering what would be the final stage of its now 8-year-old bull market, meaning the phase where the dynamics of the market is no longer this arm wrestling process, but it's far more vertical, far more dynamic. And it wouldn't shock us what kind of price levels you see over the next year or so. But what we're seeing right now is the fault of latecomers buying the buy stop at 2100, which any idiot could see, pre-validated by momentum, so we trust it, but they're getting the sell-off afterwards. Now we're trading around 2040 at the time we're doing this interview, so it's pulled back $110, 3-4%. We suspect it'll start to gel again, and you'll see it creep back up to 2150 again, and then people will say, well, gee, that was another false curveball thrown by the price charts. But we think gold is still in its bull market. We think it's crossed through this massive congestion zone, 8 years after the low, and is ready to begin. It's probably the dynamic phase of the bull trend. And I think that's where we stand right now.
What's who's they or them? I mean, it sounds like a pronoun thing, but I think you're talking about a specific entity, because you talked about when gold goes up to like 2100, they smack it down. Who's they?
Well, I don't know that it's really this time that it's a they. It's more that the buying sort of exhausted itself, meaning you had a bundle of buy stops. There, no question about it. When you look at a price chart going back to 2020, you can see that if you got up to 2100, you blew out every single high. Therefore, if you're short, you're dead and you're covered. Okay. Therefore, a lot of volume of buying. And if you're not long and you're buying late, then you bought it there. And you got a gusher. So you had basically a huge inhale. And then, now you're getting some exhale because of the buying. Frankly, you had the wave of buying that was at that price chart point. They should have been buying earlier because momentum said to. But this is the kind of turbulence you're going to see, I think, going forward, where you're going to get, instead of $100 drops over a month, you might see them in a day.
Okay.
But they'll come and they'll go fairly quickly. They won't take 6 months, to achieve. So I think that's what we're seeing now is simply temporarily exhaustive buying due to those two factors, new longs, shorts evacuating, and therefore somewhat of a void on the other side.
Well, do you mostly, because obviously I know that your business is obviously selling technical research basically to financial institutions, but do you look at the fundamentals at all, or just rely on charts 100%?
In the case of gold, we think there's one overriding fundamental. And I think when you try to link gold up historically, going back decades, for example, and try to link it up with, well, what's the direction of interest rates? Well, the correlation is no good. There have been plenty of times where we've had sharply rising interest rates and gold has exploded. 1970s, mid-70s through 1980, interest rates went through the roof. Fed was raising rates, and gold went from, a low in 1976 at $103. And in 3.5 years, it was $850, despite the Fed raising rates all the way up. So, you think, well, okay, gold can't go up if they're raising rates. Well, that's nonsense. The 1980s bull proved that. Okay. Now, look over the last year, for example, again, using rates as, let's say, your fundamental metric. The Fed started raising rates in 2022. They warned before then that they were going to. And if you look at what happened in 2022, the stock market had a 20-some% drop in S&P year over year versus 21 close. T-bonds were down 30-something%, 22 close versus 21 close. Real estate was down huge. Everything was down big, all the normal portfolio metrics. But gold closed the year unchanged, 1820s. It's where it closed in 2021. How come gold shrugged that off? I think the reason is, and I think this is the biggest fundamental out there right now, monetary policy is what drives gold, meaning the increase in the money units, the central banks printing, having to print to defend the assets that they deem to be most needed of defense, such as the stock market, real estate, and especially government bonds. Gold knows that there's a crisis coming. But where's that crisis coming from? Stock market bubble. The U.S. stock market from 2009 low through 2021, S&P went up 7-fold over a dozen years. NASDAQ 100 went up 16-fold. You cannot find a bull market in U.S. stock market history that even is nowhere close to those dimensions, nor of that duration of time. Well, why did that occur? Well, look at an M2 chart, and you'll see what happened between 2009 and 2021. And look at the Fed funds rate chart, collapsed to theoretical zero and laid there. So effectively, we had 12 years of drugged asset category called the stock market, real estate, and bonds. But finally, the bubble broke. It was going to break anyway because it had already gone too far, excessively outpriced itself, and it started to unwind. Now, once it starts to unwind, usually, always, the Fed can't stop it. This was true in 2000 to 2002. They cut rates aggressively starting in 2001, first day of the year. Stock market had barely come off its high at that point, and yet the stock market collapsed to the 2002 low with Fed funds rate cuts all the way down. Again, 2007 top. Occurred in October of 2007. The Fed had been raising rates for a couple of years up to 2006. In September of 2007, they cut rates by 0.5 basis point. 4 weeks later, the S&P made its marginal new high into October of 2007, and that was the top. In other words, if you'd shorted the first time the Fed reversed its policy and went to lowering rates, you would have shorted the top of the stock market. And they cut rates all the way down, and yet the stock market collapsed. So what we're arguing now is, one, we think the top has occurred in the stock market, measured especially by other indices than the S&P and NASDAQ, which are bloated by about 2-3 symbols: Apple, Amazon, Microsoft, especially Microsoft and Apple. They constitute, such a huge percent of the indices. I don't even know why they call them indices anymore. 500 S&P stocks, but about 30% of them are 3 stocks. Okay. We think that market peaked in January of 2022. And so far, despite the Apple and Microsoft marginal new highs that were made, in the past couple of months, the major indices haven't been able to reachieve the highs. And most indices, most ETFs that you look at sector by sector, they're not even close to the 2022 highs. So we think the top is in. The next phase of the stock market, I think, is about to occur, which is the next phase down. And once that starts, I think you'll see the data points, the things the Fed likes to chat about, so-called economic data points, suddenly start to move with the market. Rarely does a bear market, the stock market, and other paper assets get led by bad data points. Instead, the data points follow the market. Now, okay, what does gold decipher out of all that? It knows that the BS talk about raising rates is over. I think, in fact, most analysts know since November 1st that the Fed rate rise is over. The only debate now among analysts is, when's the first rate cut? Okay. Is it next summer? I wouldn't be surprised it's in the first quarter. Gold knows this. It knows that when you break a bubble the size of the stock market bubble that we just saw the top in 2021, 22, that the real world impact of that is going to be so horrendous that the Fed will have to come in, not just the Fed, the ECB, BOJ, everybody, come in and defend the implosion of those assets. US in particular, because our stock market bubble was multiple times greater than what you saw in Europe or Japan. So we're the ones that are going to suffer far more than any other major developed economy. And the central bank will have to respond to that. What does that mean for gold? Monetary policy goes back to feeding the gold market, meaning degenerating the value of the underlying money unit. Ray Dalio, like a year ago or so, issued a quote, something on this order: quit looking at the price of your stock. Instead, pay attention to the underlying value or decay of your money unit. And that's why gold had an unchanged year last year, despite everything else having a horrible year. That's why gold's making an all-time new high. Find me another major asset right now that's making an all-time new high. Gold knows something. And the thing I think recently that is really going to help gold is the collapse in the T-bonds that we saw this summer. We predefined the event as a nuke event, N-U-K-E, okay? T-bonds had ratcheted down from their early year highs. I'm talking price now, not yields. Back in March, they had a rally from last October's low to the high this March. So yields dropped. That was the same time the stock market had a rebound, and gold also rebounded from an October low last year to highs early this year. So gold and bonds were somewhat in sync here in terms of price, not yield. So as the T-bonds rolled over from their early year highs this year, so did gold. The gold had been over 2,050 again. T-bonds were well above where the October low of last year. T-bonds rolled over, instead of gently and only partly back to their October low last year, collapsed well below last year's October low, meaning yields went to new highs. That is not something the Fed or the Treasury anticipated. It's certainly not something they wanted. They're playing this, quote, incremental game. But when their T-bond market crashes, and it literally crashed, it was dropping like some commodity market, limit down almost, look, with gaps, the whole deal. That no doubt wet their pants, okay? Now, they didn't admit that and couldn't admit that in front of the public or the press, because that would admit, oh gosh, we messed up. We're panicked. They can't admit panic. But you know good and well that ends any more chatter inside the Fed about whether we're going to raise rates anymore. Janet Yellen last October, in fact, when bonds made their low last year, which we took out big time this year, and we also called the recent V bottom in bonds. We knew bonds would explode off the recent low. They were lagged to gold this time by about a month, but they did explode. And they'll likely go higher over the next several months, meaning yields will drop. But last year in October, Yellen came out with a statement that said she was very upset, distressed about the illiquidity in the U.S. government T-bond market. Yet in the crash we just had in T-bonds this summer and fall, she didn't say that. But you know good and well she had to feel that. Now, why couldn't she say it? Because it would admit panic. And they can't panic. So all their panic is behind closed doors. But you can bet, and this is where most analysts are now correct, they're not going to raise rates anymore. And it's not because of data points, it's because the government bond market is in great jeopardy.
There's a running joke online that Yellen is running around trying to get a bunch of other countries to buy her bonds and begging, country officials to do that. So someone might jump in to help her. But you know what, Mike, you're mentioning something interesting here, which is the M2 money supply. And looking at it, I've been told, is looking at the absolute chart, if you will, is kind of tricky because it's pretty much designed to always keep going up. But when you look at the rate of change, and specifically the short-term rate of change as of recently, that's been going the other way around. So yes, what do you make of that? How does that influence everything?
Yeah, that happened also. The last time that happened was in the 29 top 30, 1930 area. And of course, the reverse happened after that. They tried to defend the stock market on the way down, and it didn't defend it. It was a total wipeout in the Dow. It was like an 80% collapse over. It never crashed, by the way. The bear market. So people who are now concerned, by the way, about the issue of if the stock market crashes, gold will go down too. No, most stock markets have bear markets that don't include crashes. Period. The 2000, 2002 .com decline, 80-something% in NASDAQ. There was never a crash. Okay. But anyway, the shift in the policy will occur. Yes, there has been a flattening of the money supply over the last year or so, but you can bet that'll change. And gold doesn't look at that. It looks at the broader strokes. Because still, even if you look at the last 10 years compared to the prior 10 years and prior 10 years and so forth, generally about every 10 years, the M2 grows up about 90% almost doubles every decade. Ongoing, regardless of this, that, or that factor. It's an ongoing process. And yes, it's paused this year, but the ongoing still over the last decade is enormous growth. And that's what helped cause the dozen-year bull market in the stock market. And there's an underlying fundamental there, too. You have to think about this a minute. When you as an individual or family or corporation or municipal government, state government or federal government make an economic decision to do something, to build a new factory, to hire more workers, to buy a bigger house, to buy some property, etc. One of the major building block factors in your decision process is the price of money. In other words, interest rates. Okay. If the Fed drugs you, injects you in your arm with free money for a decade or so, then you're deluded into believing, that's a fixed, it's great, it stays low, that's nice. You've gotten to believe it, okay? And you're drugged. So one of the major premises of your decision making, one of the foundations of what you've done, is the price of money. And suddenly now the price of money has gone through the roof, relatively speaking. And so a lot of decisions that were made, not just by governments, but by corporations and small businesses and families, is suddenly upended. You can bet the data points will soon reflect that error has been made. And when error is made on such a scale over such a period of time, the vomiting consequences of those errors will show up in the data points like you can't imagine. Again, the stock market, I think, knows this. And I'll give you a number. We generally give our numbers to our subscribers, but in general, right now the S&P has tried to go back to the summer highs, which is 4,600 on the S&P. Again, this is largely due to Apple and Microsoft, which are now fading pretty quickly, by the way. S&P is now dropping into the mid 4,500s. You get down into the mid 4,200s anytime in 2024. It's about 6% or so below the market, and it's over. Now, the low last year, and the low of the bear move in 2022 was 3,500. So we're well above that. So it looks like when you look at a price chart, say, whoa, we're well above that low. The low we just made prior to the recent rally was just above 4,100. So when you look at a price chart of the S&P, getting down to 4,250 doesn't look scary, but I'm telling you on an annual momentum basis, you've got a triple bottom breakout pending there. And if you even go back to that level, you will not hold in that point. So 6% below the current market's all you have to give back. The next phase of the bear market begins. Only this phase of the stock market bear will become obvious to everybody. And you'll have your data points. So if you want data points, hang in there. You're going to get them. Again, for the reasons we just discussed, the underlying errors of a decade plus. What would be the beneficiary? Gold. Real money versus fake money, period.
They say triple tops never work. Do triple bottoms work?
Triple bottoms hardly ever hold, no, even on price charts. Now, what we're talking about, fortunately, is momentum. And what we like is that when you look at a price chart, again, you see these irregular lows since 2022 and 2023. But on momentum, when you run a 3-year average momentum chart, where you plot each month's range, price range, in its relationship to a 3-year moving average, for example, or we sometimes use a 36-month, which is a smooth 3-year. But when you plot that range, you're either above it or you're below that average, right? Okay. Well, all during the 2009 to 2021 move, starting at about 2011, you broke out above the 3-year average and you lived above it. Now, in 2022, you came down to that average, traded slightly below it, closed no month below the 3-year average that year, neither in the summer nor the fall. This year, early 2023, you traded down to the rising 3-year average at a different level, traded below it, but did not close a month below it. So 2022's lows, 2023's lows, on a price chart, they're different, but on a momentum chart, they're on a floor. Don't go back to that floor. It will not hold. Next year, which is to say 20 some odd trading days from now, if you see yourself in the mid 4,200s, put your helmet on. Because that's the point at which, when the stock market starts its next leg, which will not be an arm wrestling match. We described the first bear leg when we got bearish in January of 2022, would be arm wrestling, meaning it would be confusing. You'd be mostly downside, but there'd be a lot of rallies that made you feel comfy. Just like, well, in 2007, for example, while the S&P was floundering all during 2007, basically topping out. In fact, most indices like financials and so forth were well off those highs by late 2007. But the S&P managed to get back up to its highs, and when the Fed cut rates, it popped through the highs marginally. But basically, it was an arm wrestling top, 2007, if you look at a price chart. It was very confusing, but it was a topping pattern. And we got bearish, for example, in January of 2000, and warned that it would be an arm wrestling top and might even see a new high. Well, there was. In August of 2000, the S&P went up, made a marginal new high monthly close. NASDAQ didn't. NASDAQ started its decline. But the S&P had this arm wrestling thing where, you felt sort of comfortable if you were a bull. You said, oh, it's not going down. It goes down, keeps going back up. It felt comfy. Sort of like what the S&P's doing. Although, frankly, if you got out in early 2022 or the top ticks in 2021, you've not seen those prices since. And certainly not in most sectors, which are way off those highs. But it didn't begin. It was an arm wrestling process. Well, I think that's what we've seen since mid-2022 to the present, is an arm wrestling effort to try to create a bottom, which is not a bottom. It's just a process of laborious arm wrestling. The next phase begins if we drop about 6% from where we are now. Now, that's the point at which I think you'll start to, one, get some emotion out of investors, where all the hope of the last year about the soft landing nonsense, by the way, that term was invented in 2000. There was a belief structure back then, too. When that belief goes out the window, and investors sort of say, oh, gosh, I fooled myself, and the data points start to shift, you're going to see more and more large non-gold bug type asset managers, managing billions of funds, suddenly say, hey, I need to move a little bit more money out of this normal sector that's not performing that well into something that's been performing. What's been performing well? Gold. And a lot of them realize why. The Ray Dalios of the world, and there's others who've sort of expressed a reason why. They know it's monetary. And if you start to break that paper asset category again, the stock market, real estate, which is weak as hell, and so forth, the central bank is going to reverse course again. And I think you'll see that evident in data points, which then they can use as an excuse, and their policy change. And that's why gold has been hanging around repeated highs above 2,000 for the last 3 years, because it could see what was coming. And it's coming.
Well, on the note of the soft landing thing, though, what about Powell's remarks from last week? He came on. He pointed out that I believe he was talking about core inflation that had ran at an annual rate of 2.5% over the last 6 months, which I suppose is a big caveat too. But it basically means that they're advancing towards their 2% goal nicely without having broken anything that's at least obvious to most people out there.
At this point in time, yeah, quite right. At this point in time, the data points will always be lagged to reality. That's step one. Already some of the data points have started to soften, and that's what's caused a lot of major analysts to now shift their view that no, there's no more Fed rate rises, period. That's hardly on the table anymore, and they're right.
What points are those? What data points are you using there?
Oh, all the ones you want to point out, CPI, unemployment type data, any data points that would indicate a softening in the economy, industrial output, and so forth. Whatever data point you want to pick on, okay, issued by the government, possibly manipulated by the government, whatever, it doesn't matter. Watch the stock market, because when it rolls over again, the data points will follow it this time. They follow it. It doesn't get led by the data points. And the Fed will then have an academic excuse to shift their policy back to what they're supposed to do when the other type events happen, the negative events. And gold knows this. I think gold has been around, thousands of years. It's not like the S&P's been around since the 1950s, or the government T-bonds have been around, a century or not even that long. So it's an old market. It knows things. It knows about degradation of money units, government money. That's why, if you look at gold has replicated the constant decline in the underlying value of the dollar. When I was a kid, a loaf of bread cost like 20 cents. Okay, what do we have, a wheat crisis right now? Is that why a loaf of bread's 10, 20 times that? No, of course not. It's a degradation in the money unit. That's why gold, instead of trading at $30 like it was 50 years ago, is trading at 2,000. It's an ongoing process perpetuated by boom-bust cycles caused by central bank monetary policy boom-bust cycles. And we've got another one coming, because the bust that's coming is likely to be far greater given the dimensions of the boom that is now broken. Therefore, their monetary policy excess going back to what they do well is likely to be excessive. And I think in part that's also true with what's going on in Bitcoin. We do analyze Bitcoin as well, and we've done very well with that. We were bearish not far coming off the 70,000 highs, and we turned bullish months ago. And frankly, we've done some things recently that indicate, while it was out of sync with gold for a good period of time here recently, is now back in sync with gold. Now, what's causing the strength in Bitcoin? I suspect it's also a suspicion on the part of some investors about the underlying value of fiat currencies, and also perhaps the desire to have privacy.
When you open up a podcast or Twitter or whatever, it's a general belief, like everybody seems to agree that basically the dollar is going to zero. But then at the same time, you also have sayings that people say that these things don't happen when everybody expects them to.
No. I agree. No, the dollar has been in major decline since the 1980s. You go back and look at a chart, it's $160, the dollar index. Now remember, the dollar index is hardly an index. It's 57% euro. Okay. And about 17% yen. So it's really two currencies, but mainly it's an inverse of the euro. So look at a euro chart. Okay, but anyway, the dollar index has had several major multi-year rallies in the context of this ongoing decline from the 160 level down. Now we had a recent high at 115, and now we're trading at 103. There are some trigger levels on the dollar index, reverse sort of trigger levels on the upside for the euro, for example, that you could better not be around where you are now starting early next year. Because some annual momentum now, not price. You look at a price chart and you think, well, 103, I can, no big deal. We traded under, down to 100 area months ago. So, it's going to take something in the mid 90s to spook most people. But long-term momentum says you don't want to be around 104 to just below 100 anytime next year. You can start breaking some big stuff on annual momentum, which will probably lead a price decline. Momentum usually leads price, in which case you're going to get the decline in the dollar that a lot of people are looking for. Not going to zero, because remember, all the dollar index is measuring one piece of fiat currency versus another piece of fiat currency. It's pardon, one piece of crap versus another. Okay, so it's not like it's virtuous or unvirtuous. You're measuring it versus other currencies that are also being devalued, just at a lesser rate, perhaps, from time to time. But also, there's not a good relationship between the dollar and gold when you stand back and look at it. If you go back and look at the December close in 2015 on gold, the bear market low, it was around 1,064, I think was the low monthly close. Okay. Find that same month on the dollar index chart, and it was trading around 97. Okay, dollar index, December 2015. Well, it's been both below 97 and well above there since December of 2015, talking dollar index now. Right now, it's 6 points above where it was at the close of 2015, dollar index. So it's actually risen, trivial amount, but still it's up. It's higher than it was in 2015. Why is gold more than double where it was at the end of 2015? So if you use the dollar index as your metric to buy or not buy gold, you missed on a doubling in gold already by looking at the dollar index. Doesn't correlate that well. There are times when it does. For instance, over the last year or so, the dollar index has been pretty well inverse to gold on month-to-month swings. But over longer periods of time, it doesn't necessarily connect that well. You could probably get a chart of the rainfall in Dubuque, Iowa, and find correlations between the rainfall amounts and the price of gold. Okay, I'm joking, of course. But I do think the dollar decline that's likely to come, the next phase of its multi-decadal decline, is around the corner, and that will further enhance, but not necessarily be the key factor of why gold ascends sharply. It's just another factor.
Well, I've tried plotting my wife's moods against our annual budget, and sometimes they correlate as well, but she doesn't agree with me.
Excellent.
It's okay. This sort of the moment in an interview where I get you to tell me that gold is going to 10,000, so I can put it in the headline and get a bunch of views. But what is possible? What is realistic?
Well,
given
Sure, why not? Okay, look at the bull markets that preceded us. You can start from the mid 70s. Gold was coming up out of the $30 area, and it went to 250, then it pulled back to 103, then it went to 850. Okay, over a decade, less than a decade, it went from the 30s to 850. And even if you want to measure just from, let's say, the 1976 bear low, which was a pullback from $200 down to 103, almost a 50% decline over a year and a half. If you start from the 76 low to 1980, well, I mean, you went from 100 to 800, eightfold move. Okay, while rates were rising, by the way, stock market was doing nothing. It was a wasteland. And gold vastly beat commodities during that time, too. Commodities happened to be tagging along with gold to some extent during that several year period. Eightfold. Okay. Now, then go back to the lows that occurred after the 1980 peak. In 2000 and 2001, gold got down to about $250 an ounce and labored there. So from 250 to 1920 over a 10-year period, you do the math, okay, another almost eightfold move. Okay. Most of that occurring, by the way, just like it did in 1979, the last year of that bull market. In 2010 to 11, most of the bull market occurred compressed at the end of the multi-year advance. Okay, so far we've only doubled. And yet you have these fundamentals we've been discussing, and also the macro technicals that indicate, oh man, monetary policy is going to go berserk. We know it's going to have to. That's what central banks do. They have to save their government bond market. They have to save certain paper assets that they deem worthy. And gold is going to be the prime beneficiary of this as investors determine that, oh, I don't feel comfy being in the stock market anymore. Bond market's questionable, certainly was last year. What's doing well? Okay. So suddenly there's very few places to put it. So the money moves over there, and it always has over history. So if you do an eightfold from the 2015 low, we're at $8,000 gold. Is that abnormal? No, you've done it twice before in the last 50 years under lesser circumstances. So even just talking fundamentals and talking loosely, an eightfold move, another normal move. Well, okay, but we don't have a normal situation here. We don't have a normal bubble breaking in the stock market. This is not 1929. That bubble was only a threefold bull market. It's not the 2000 .com. That was a three or fourfold bull market. It's not the 2007 stock market top. That was only a double from 2002 to 2007. We have a sevenfold or 16-fold bull market that's breaking, indicative of the monetary policy that fed it and is going to have to refeed it to keep it alive, or try to. Where's it going to go? Where it always goes. So therefore, you can put the 8,000 out there if you want, but all that is replicating the 1976 to 1980 move, mid 70s to etc. It's usual. It's normal. So I don't know where it's going, except a doubling is trivial.
What is what is the time period that we're talking about here? Because it's not this. I mean, there's been an eightfold, as you said, but it's not been within the same time period. Like it can take anywhere between 5 to 15 years.
Well, usually it takes 10 or so. But I would say this is now 8. I think we're going to move into chaos theory time here. We've had an incremental gold bull market. We've had many declines that people thought was the end of the world. And of course, once it ended, within a couple of months, bam, you're back to the high. Okay. And that bad dream went by the way, just like the one we had in October last year went to 1600s. By the way, that was only a 20% drop from the high. It's a borderline corrective by most notions. But anyway, and then we had the decline to the low 1800s from above 2000 this year. Now we're back over 2000 within weeks. It took it 6-7 months to decline that much, and about 6-7 weeks to take it all back. Okay, where are we on the clock? I don't think you can measure it exactly in years and say, it's got to be 10. But I do think you should expect that in the last year or so of the bull, usually fairly aged at this point in time, you get acceleration. Now, this is why at MSA, we don't just look at gold. We look at other tectonic plates that are moving. And I think right now, the one to watch closely is the stock market, inversely to gold. I know a lot of people think, if stock market goes down, gold's got to go down. It's baloney. Wasn't true in the 1980 bull, 1979 or 80. And it wasn't true, of 2022, for example. The only time they seem to is burned in their memory is that 1 month in October of 2008 when gold did have a crash-like event that duplicated what the S&P did that month in October 2008, late in its bear trend. Gold suddenly joined the S&P for one horrible bad month, but then within months was back to its high, whereas it took the S&P a couple years to get back to its prior high. So people only remember those little burnout moments that are really just short-term pullbacks within a longer-term context. So anyway, I suspect 2024 is going to be a hellacious year for a lot of markets. And there's another factor that's not discussed in the press, and I don't know why. And I think it will become to the fore in terms of market considerations, and that's politics. We're seeing it throughout the world where there's a lot of upheaval, where the orthodox long-term ruling parties in various countries in Europe, Argentina recently, for example, are being upended by what are in effect revolutionary type figures, or at least upsetting political figures who are upsetting the orthodoxy. In the case of Argentina, it's primarily economic reason for the revolt, youthful for Milei, who's an anarcho-capitalist, which is what I am as well. I wrote a book on it 50 years ago. Okay, pardon. In the US, the politics, everybody knows it's a divided country. Okay, everybody admits that. Never before has it been so divided intellectually and politically. And now suddenly we have an election coming up where either side is going to be very unhappy if the other side wins. And when I say very unhappy, I don't mean they're just going to be upset and wait for the next 4-year election, but they're going to do things that aren't expected. There was a poll recently done by an academic institution among Democrats, and this is several months ago, by the way, it's getting worse now, where it was like, I forget the exact number, pardon me, 20 or 30% of the Democrats said if Trump were elected, violence would be justified. Period. Okay. We know on the other side, if Trump ran and lost the election, there's already upheaval in various forms around the country. There's many counties in the country, including in Illinois, want to secede from their states because the state is too liberal, let's say, and they want to break off and have tax-free county or something. True in Oregon as well. Texas has on the ballot a measure where the legislature, if the measure passes, so I think it's on the 2024 ballot, and I forget the exact number of the document, that if a majority vote for this, the legislature has to seriously begin to consider secession from the United States. Okay, now, the fact that this even talked about should be front burner issue. But it's not, you turn on CNBC or something like that, you don't hear this chatter. It's all, oh, this data point, this company's earnings. That doesn't matter. I think we're entering global political upheaval, particularly in Western countries, that is going to cause 52 card pickup, where all assumptions go out the window because of the political variables at hand. And I'm not going to argue one side or the other. I'm just saying either way, there's no outcome that is going to be copacetic. And I think as we get into the year, I don't think you have to wait for the election. That's going to come forefront issue, and it's going to become more apparent. Already there's books being written and editorials being written that Trump is a dictator. Okay. So the other side is already ready for that, and they're defining him as a dictator. So if he gets elected, don't expect it to be peaceful, and vice versa. So again, standing back as an observer, not an advocate, I'm just looking at these pieces, and they're not going to fit together again. That is a market variable that is not put into the market.
Yeah. Whoever it might get elected, I guess in the end, it always results in more government. So you and I always lose. But
less.
well,
yeah.
that I suppose is what would be the interesting situation. But where does that fit within determining where asset classes might move to? Do you mean more fear is good for gold, or how do you mean?
No, I think it's just the instability and the doubt, especially regarding government debt markets. Right now, we got bullish when we declared the nuke event in the bond market. We said it was going to crash, but it would also V-bottom. And we got our buy signal like on TLT in the mid 80s. Right now, it's trading up well into the 90s and likely to approach 100. Nice rally. I think it'll last several months. I think it's in part due to some asset managers moving money over there, and the Treasury and the Fed probably secretly buying the market. They have to. But the upheaval generates a sense of wanting stability, something you can count on. And if you can't count on the dollar holding its value, And if the stock market creates doubt about its stability, such as going down to the numbers I informed you about a few minutes ago, then where do you go? Why is gold making all-time new highs? Why is it even back to the highs? That, finally people realize it. Something's going on here. This is stable. It's holding its value. My neighbor told me to do this years ago, and they didn't do it. And he's smiling, and I'm not. And as long as this persists and suddenly it stands out as an asset category that is holding its value and gaining, then suddenly you get the crowd effect. And I think right now the issue is, one, we've created doubt about not just the bond market, but the US government bond market, about its stability, its liquidity. That's a huge, portfolio component. The old 60-40 rule, 40% bonds, 60% stocks, you're good, all right? Well, 2022 disproved that notion drastically. And if the stock market suddenly becomes a negative, then you're left with very little. And so, I think it'll go there. Now, the question is the ultimate outcome of something like this. Even if the ultimate political outcome is what I might consider to be good, which is to say far lesser government. Finally, the decision is made by enough people who say, this hasn't been working. Somehow my life has been a boom bust cycle. Why? It's not because I'm incompetent at my job. It's that bigger things outside of me are causing booms and busts. And even there's some major economists out there. You've heard them over the last year, for example, who are not necessarily anti-Fed economists. There's very few of them anyway, but who said a year ago, hey, you're going too far. You're going too far. And now suddenly they can look back on their academic statements and say, see, I told you, Fed, you went too far. And so to some extent, they've already intellectually divorced themselves from the notion of a monopoly central bank over money. Now, what if, and we argue this, and it's not an essential, but my bet is in 5 years, there won't be a central bank in the U.S.
All right, that's an aggressive timeline.
The dysfunctionality of it, and enough people are recognizing, hey, this boom-bust cycle in monetary policy has also led to a boom-bust cycle in the stock market and assets. And, maybe something better works. And even if the revolt, the political revolt that we see, not just here, but in Europe, various parts, Argentina is a good example. They had decades of Peronist socialism, now totally overthrown by this young guy who's an academic libertarian. He's written books on it. So two major parties now, the Democrat and Republican, both of them socialist leaning, and he comes out of nowhere and throws them both out of power. What was going on there? Argentina used to be the 7th biggest economy in the world decades ago. Literally, it was. And now it's, 20th or something, because they've gone into constant decay. And suddenly the young people say, I'm tired of this. And they may not know exactly what Javier Milei is explaining in his books, but they know it's something different, and maybe it's better. Less taxes, maybe ultimately no taxes, less regulation, abolish most of these government departments, et cetera, et cetera. And then you say, I've had enough, okay? And it's a panic moment. Not necessarily intellectually grounded on the part of the voters, but still enough sense of discord to say, end this. Well, what if that starts to happen in the US, where the two-party process, which has really led to nothing but larger and larger government decade by decade, regardless of which party happens to be in power, it's never really ended. The intrusion into your life is increased constantly over the decades, with this excuse or that excuse. And when people suddenly say, I'm just tired of this, sometimes there's pain before the good results. So the argument about, well, which asset category is going to benefit from this? Ultimately, it might be stocks. Ultimately. But the birth process of getting rid of something that the public perceives to be not necessary or excessive, the birth process might be painful by the time you get to that point where suddenly you have a freer market. And therefore stocks are oversold and you've got a freer market, time to buy stocks again. But of course, who knows where the S&P will be then. But the point being that no, the ultimate outcome of this is primarily a chaotic outcome in terms of investor sense of where to be.
I think the only people not complaining about Argentina's economical situation with the gringos who were buying $5 steaks for like the last 10 years. But the rest of it was pretty bad. So you make a good point there. And I hate to hit you with a cliche here, but Peter Lynch said that more money has been lost preparing for a correction than was lost during the actual correction over the history. So what do you do with that? I mean, if you're if you're waiting for everything to crash and you get out of the market at the wrong time, but then over 20 years, the market, has done what it did over the last 20 years, and then you basically had an opportunity cost. How do you deal with that?
What's happened? Go back and look at the 29 top and the 32 low, which is a wipeout. It took till 1953 to get back to the highs again in the Dow. Okay, from the 1932 low. Then look at the mid-70s peak in the S&P, and then effectively the crash in 74. By the way, in 74, gold was exploding while the stock market was collapsing. Okay, and then the stock market rallied into 75, 76, 77, but it just basically was a wasteland until 1982. So almost a decade, well, more than a decade from its mid-70s high to 1982. Investing in the stock market was a waste. I was a futures broker back then. I started MSA in 1993 at the request of a large bank that wanted my research, but I was a futures broker and, retail office. I think it was with Beige at that time. And this would be 76, 77, 78. And I remember, and I'm not a great salesman, and that's what brokers are. They're salesmen. Thank God I got out of that business. I was making more money month to month than any other stockbroker in the office. Their phones weren't ringing. In fact, most of the time you look at a booth where the broker would be, he's out to lunch all day. Why? There's nothing going on. It was a wasteland. Investors weren't interested, and rightly so, because you didn't make money for so many years. And yet during that time, gold, went from $103 to $850, from the 76 low to 1980 high. So, the question is not just whether the S&P goes down and then you have another 20-year up. You may labor for a while. I'm not arguing the S&P has to get decimated 90% or anything like that. I'm just saying that it's likely to have a bear market of large dimensions and not be good for people to invest in. And it may take a longer time to turn up than the prior lows. Remember, the prior lows were helped sparked by the market was oversold vastly. For instance, we got bullish in March of 2009. 1 week before the low, we said the low is coming. We predicted 670. It stopped at 667. Okay. S&P, we said major low. We didn't know it'd go for 11 years. I'll have to admit that. But at that point, the market was vastly oversold and the Fed was pumping money like crazy. So you had two reasons to buy the stock market, and they both worked in combination. At least you have an oversold market. Now we don't have an oversold market. And it's likely you're going to see a similar type thing you had in the late 70s, where the money flow didn't go back into the stock market. Despite the 74 crash in the stock market, the money flow went into commodities and went into gold primarily. I think right now, you turn the stock market down, the increased money flow will not go into the stock market. We'll instead go back into a resumed up leg in commodities and a much larger up leg in the monetary metals.
Monetary metals. That's interesting right there, because over about an hour or so we've been talking about gold. But what if we switch the word gold in it across everything you told me over the last again an hour or so with the word silver? Would the conclusion still make sense?
Same thing. I think silver, if you go back to those two prior bull markets, multi-year bull markets, the mid-70s, 1980, or 2001 to 2011, and look at what silver did. You don't even need a momentum chart. Okay, go back and look at a monthly price chart of gold and silver. In fact, we put out a report on this a month or so ago showing what happened in the dynamic final phase of those old bull markets. Silver went ballistic. In other words, while it was an arm wrestling match and looked like a laggard, it was a laggard compared to gold for the first 6, 7, 8 years of the bull market. In the last year, when gold might have doubled, silver went up 4 or 5-fold. So there's a phase in the bull markets, usually late in the trends, when the other monetary metal, or what they call, poor man's gold, suddenly wakes up and goes ballistic even more than gold does. And I think we're near that point right now where silver, and we measure this technically, by the way, not just, we run spread charts, meaning the price of silver in relation to gold, but we also measure the momentum of the spread charts, looking for breakout structures. Silver is very close right now to where the momentum of the spread, which is starting to rise, by the way, favoring silver, especially since last year's lows. Remember, silver was down there $17 at that time. Silver right now is trading 25. Gold back then was 1600s, now trading 2050. So silver's already had a bigger percent gain off that low than gold has off of the 2022 low. But with a little bit more push by silver, it will cause its long-term momentum of the spread to break out into bull mode again. And we think that's likely to be timed with what we call the final phase of the bull market, the dynamic phase of the net price gains in silver and gold, where not only do they both go up more vertically, but silver suddenly starts to outpace gold vastly. Now, another point on that. If you measure the spread of silver versus gold, expressing the price of silver as a percentage of the price of gold, meaning right now silver, for example, is about 1.3% of the price of an ounce of gold. Okay. Since over the last 50 years, silver has been as high as 6.5% of the price of gold, and many times above 2.5% the price of gold, even up to 3.5%. Well, let's say gold did a routine bull market and went to 8,000, matching the dynamics of the 1980 peak or the, et cetera, or the 2011 peak in terms of dimensionality. And silver went to 2%. That's $160 silver. But what if it went to 2.5%? It's been there routinely. You look at a spread chart of silver versus gold for 50 years. It's not like some rarity to see silver at 2.5%. It's almost like a normal inhale, exhale. And if gold went to 8,000, silver went to 2.5%, silver would be 10 times its current value. Okay. So in the final phase of the bull market, if that's what we're entering, and we think we are, we think it'll be evident, especially as we get into 2024. I think already the signals have been rendered by momentum right now. Price is having its fist fight, lagged to momentum. But during that phase, so let's say over the next year or so, that's when the dynamics change. And you don't just get a bull market, you get a dynamic one. But you also get silver to vastly outpace gold, which is what it did late in both of those other bull markets. It came to life then. Also, that to some extent is true with the miners. They quite often will lag gold until certain brief points, like 6-month bursts, where they go berserk relative to gold. Look back at 2020, for example, when silver doubled, $15 to 30 in about 6 months. Gold went from 1,400 over 2,000, nowhere compared to silver's gain, and gold miners like tripled during that time. Now, they gave it back since, but there's burst of time where the silver and the miners outperform gold. And I think we're on the cusp of one of those moments right now.
And I have to bring up fundamentals here again as to why that ratio between gold and silver has been holding up or has held up in history. It's because of that argument about it being poor man's gold. But I heard I was at a conference recently last week, I believe, in Germany. It was the German Gold Show. I actually have a pen from there. And I was listening to a silver CEO, a quite famous one, who was making the argument that he doesn't see silver as a monetary metal anymore because so while gold has been money, it will continue being money because of its physical properties where it works well as money. We don't need silver anymore in that fashion because of partial ownership of gold and whatnot and a bunch of other things that we have coming into the market. What will you make of that argument?
Silver's always been an industrial metal. We know that. And so, that is a factor. Gold is far less an industrial metal. So that's not an issue. I don't debate that. No. But again, we're talking not some rational argument here about, percent that's consumed by electrical devices using silver and so forth and so on. It's an emotional issue to some extent. It does hold its value versus degrading paper, just like gold does, in a bit more irregular manner, let's say. But its history is that even though it is a, let's say 50% industrial metal, whereas gold is not, there's those phases late in the bull trends where it goes berserk, and that's when you get this panic desire to own monetary metals. And silver has been money for thousands of years, just like gold has. So that attribute exists for silver. It's not something recently invented. So yes, it's more irregular, it's more emotional, it often underperforms gold, but there are times when you can measure technically when that phase is going to end. Early 20 to summer of 2020 was such an example. It broke out on a spread basis and doubled in price in a handful of months, whereas gold did not. We think something more dramatic is likely to occur here, and also more protracted, not just a month or so, but probably a span of several quarters or a year. But again, when you look at the two monetary metals, watch the other tectonic plates because they're very important, especially to the central bank. The central bank is a key factor here because when they get put into panic mode, and their crash in their T-bond market recently put them in panic mode. That's an event that they did not expect, could not control, and no doubt wet their pants, okay? They didn't admit it, but they had to internally. So if things get worse and suddenly we start to see the other paper assets continue their decline, except in a more accelerated way, talking real estate, stock market, municipal bonds, high yield corporate debt, which, by the way, those two markets, muni bonds and high yield, didn't crash like the T-bond market. So the recent T-bond crash was far more dramatic, though quote unquote safer asset, right, than high yield corporate debt or munis, yet it crashed more. That really had to put panic in the Fed. But when debt markets and the stock market start to weaken further and the data points follow, the central bank's going to revert back to that which they were born to do, print money. And except this time, they're going to need a hell of a lot because of the nature of the bubble that's breaking.
What other tectonic plates are important in this case? We mentioned bonds, the stock market.
Commodities.
So energy, for example?
Yeah, and the energy is a lesser factor this time around. In October of 2020, which gold had already doubled between late 2015 and summer of 2020. During that same period of time, from 2006, late 2015, when gold bottomed, commodity market measured by Bloomberg Commodity Index started to slow its decline, but continued a layered decline all the way down till mid 2020, which commodities went down while gold doubled. So the correlation is not that good all the time. Now, in the late 70s, especially from call it 1978 to 1980, commodities did go up while gold exploded from mid 76 to 1980. Okay. They joined it to a lesser extent, percentage wise, but still they joined. So back then, when other assets were not looking good, gold and commodities look good. But again, they don't always link, those two. The last 2015 through 2020 being an example. But in October 2020, we put out a report, and at that point in time, Bloomberg Commodity Index was trading up from its low, which had been just below 60 in price, to just above 70. We put out a report that said commodity explosion coming. It wasn't based on expectations of a 2022 invasion of Russia into Ukraine, which everybody wants to blame the commodity move on. We're talking late 2020 now. Bloomberg doubled, went from 70 to 140 by the time that war started. And frankly, when that war started in February, commodities peaked a month later, almost universally. Grains, oil, you name, you could have thrown a dart at it. They all went up together. They all basically peaked together, and they've come down to varying extents together. Bloomberg is now back down in the 100 area. So it's given back 40 points of its move from 70 to 140. We think Bloomberg now is an asset category you need to watch, commodity category, and stocks related there too. Grain related stocks, energy related, and so forth. That there's another leg coming on the upside. But I think this time around, whereas the first leg was primarily led, not exclusively, because all commodities went up then, but by energy, especially oil and natural gas. they were definitely the places to be in the Bloomberg at that time. They've since pulled back, and they've been capped off recently. And I think we're probably at a level on oil and natural gas where, from an investment grade point of view, you could probably buy it. I don't think they're going much lower than this. That's not the issue. The issue is, to what extent are they going up now? And if the commodity upturn occurs, and we think it will soon, we've got some very specific numbers month by month that we issue. In fact, our buy signal for Bloomberg that indicates the return to the upside was missed by 1 decimal point at the October close. We had a specific number for the Bloomberg to close at. It closed 1 decimal point below our trigger number and then fell. So we know our numbers are probably good. Early next quarter, it will take a lot. So numbers will shift. So quarterly momentum will turn back up with much effort on the part of Bloomberg. But we think probably the leader this time on a percentage basis will be the grains.
Okay.
Now, wheat's been punished severely since the 2022 highs, more than almost any commodity out there. It's back to where it started almost. Not so much soybeans and corn, but they've been punished a lot. So I know most people don't like the grains right now, but we would argue that, technically speaking, they look more optimal to shift into an outperformance status within the commodity category than does, for example, oil and natural gas. Though I think they'll all go up together, I do think that the grains are probably the place to look. Now, as we know, recently, meats have gone through the roof, especially cattle, all-time new highs. So I'm not food category. Sugar's also gone berserk, so is cocoa. But I'm looking specifically at the grains. And I strongly suspect that when the central bank again starts printing again, and they probably already have, actually, on their balance sheet to defend certain categories. I'm sure they've been buying the hell out of T-bonds. That money flow, rather than going into the stock market, which is where they'd like it to go, just like in 2001, they cut rates and cut rates all the way to 2002, and yet the market went down. Investors didn't want that. They didn't want stocks. They distrusted it. Same in 2008. Fed cut rates all the way down, increased the money flow, didn't help stocks. So they can play the same game this time, but I think major investors are going to see risk reward not being there, but in still fairly depressed commodities. Now, what do I mean by depressed? Everybody claims that, oh, we just saw a commodity bubble, blah, 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 blah. Yeah, year over year, it was a big percent gain, a year ago, measured with the year before. A big percent gain. But when you look at the actual price of Bloomberg, made a low in the high 50s in 2020. Its bull market peak in 2008 was like, I think, 267. Okay. And its bull market secondary peak in 2011, coincident with gold, was about 170. And our recent rally high in early 2022 was 140. And now we're back at 100. So at the current price level of around 100 versus 170 in 2011 and 267, I think it was, in 2008, commodities are still vastly depressed. So are commodity-related stocks. So you're a big portfolio manager, and you're looking at asset categories and looking for a place to be, relatively speaking. Again, relative is a big issue for them. Doesn't have to be going up. Just be better than elsewhere, okay? And if stocks start to jeopardize themselves, which I think we will, and it starts to cause portfolio managers to again begin to doubt that category, they're going to both move into the gold-related and commodity-related because of the risk-reward perception, and it's valid. So I think commodities will participate in the next up move in gold. And thank you, Fed.
Well, let's hope we can say that. Thank you, Fed, because most people have been saying end the Fed for a while now. But it's that commodity index, that Bloomberg commodity is mostly made up of oil, if I'm not mistaken.
No, it's well balanced. Some of the others are definitely heavily weighted in oil, but no, Bloomberg is far more evenly balanced. In fact, gold and silver are a component of it too.
Right. I think the GSC,
that's heavily energy.
Oil.
Yeah. No, Bloomberg is. That's why we use it in our analysis, because it is not so biased toward oil.
Right. Still a heavy portion of oil, obviously, in there.
Yeah.
And what's lacking in these indices, and even when it comes down to energy, is uranium, which is something that has been performing very well recently. And then you talk about the managers looking around thinking, hey, what's performing? Where can I put money in? Well, uranium is at over $80 now. it was
Yeah.
18 in 2016.
Yeah,
It's the
we
best performing
actually, no, it was
commodity.
lower than that because we got bullish back in like 2017, 18 when it was under 20. And there's nothing changed since then in terms of annual momentum of
Yeah.
uranium. We measure it versus the 36-month average. It's structural action. It tested that structural support recently in a pullback, I think down to the 50s, and then shot up again. So I wouldn't be chasing uranium here. It's definitely beat the hell out of oil and natural gas. But I mean, you're right. Look at what it's done. Look at the ratio of gain it's had. URA, which is the ETF of uranium-related companies, is probably got a lot more to go than uranium because it's somewhat lagged uranium.
Yeah.
But and so if I were going to be in energy, I'd be in the uranium-related stocks, which is URA. It's an ETF.
Right.
But I still think the grains are a slingshot situation, whereas energy's not so much of a slingshot anymore. Yes, turn up. Yes, uranium might go further, but I think it's the core foods, the grains that have the most dynamic in terms of percent gain. So I think that's a technically based assumption based on when we look at the momentum charts of these various components of the Bloomberg. That's the one that looks like it has the keg of dynamite to blow through. Meaning, if you looked at its momentum chart, not its price chart, you'd say, "Ooh, that looks like a heck of a base." You don't quite see that on price. You see this tube. Well, momentum, you see what we would call definitely a base that looks dynamic. It's quite wide. So that if momentum breaks through the top of the base, you're going to have a bang-up rally advance. And I think it's going to be the grains.
Well, I don't have an opinion on grains. Besides that, I don't like eating them, but my doctor's been talking about fiber all this time, so I suppose I have to. But I do have an opinion on uranium there, and I don't think uranium dances to the same tune as most of the other commodities because of how inelastic the demand for uranium is. And given how the fundamentals are set up now, could it not do something out of the ordinary?
Ongoing, yes, it could be. It could be. As long as it's up, it's up. But what I'm saying is, yes, by our dynamics, its trend is positive. It's got a well-defined annual momentum trend structure that you can't quite see it on a price chart. It's not so perfectly measurable. But on momentum, you can see it. And we update that once a month. We have a monthly commodity report. We update all the components of Bloomberg. And while it remains positive, it's definitely not what you call a prime entry point. So that's my only caution is that if you don't get in at the right time and you're a latecomer, beware of that. Your risk reward is not the same. And so while, yes, uranium could keep going up, and there's no question there's a fundamental change in the world, it's also part of the political upheaval we were talking about. You know, where a lot of countries said, no more nuclear. We're going we're going to go to solar and wind. Like Germany is an example of that. And a lot of European countries, including, quote, socialist countries, are saying, screw this, the green stuff. We're going nuclear. Okay. Why? Because it's effective, it's clean, and so forth. And so there's a sudden reversion. And for some reason, the French have long been 80, 90% nuclear anyway. But a lot of Europe is shifting to that. And I think the U.S. is probably going to do a lot of shifting in that direction as well. As a stable, reliable, clean source. And so a lot of assumptions that were politically based are getting tossed, and, including that one regarding energy, and maybe some other political assumptions as well along the way. But I think that is part of that process, that upheaval, is the recognition that, no, we were wrong in denouncing nuclear. And so there's a sudden reversion back to it. And it was definitely way, way too cheap for too long. And so when it came out of the hole, it came out of the hole. And right now it is positive trend. But again, if you enter it, realize you're not buying at an optimal entry point.
What do they say? The trend is your friend until it ends?
Until it ends, yeah.
That's a good point. Yeah.
Now, when it ends, it doesn't necessarily mean that uranium's going to crash back to some deep low. But we'll define a point where it breaks enough where we say, okay, probably the next year or so, uranium is not going to be a good performer. It's going to pull back some. Maybe it'll go to 100 first. I don't know. But when it does break its annual momentum trend structure, at that point, it's telling you, okay, if you're already long, it's best to get out. And two, it's probably going to stay broken and corrected for a good while. Right now, we're not in that position. It's still up. It's very ballistic, no question.
I was hoping you can tell me uranium is going to go to 500 so I can put that
That'd
in
be
the
nice,
title
yeah.
too.
We can't always come up with a projection. Sometimes we do project a target, like we mentioned on gold, what it's done routinely before, but that's hardly our target. We're just saying that look, it did it twice before. Why can't it do it again? Eightfold.
Yeah.
Uranium, I don't know. I don't have a target on it.
Yeah.
We just know the trend is up until it's not, and we'll tell you when.
Well, targets are good are a good marketing tool because they get a lot of attention, but then it's really the analysis behind it that makes sense and that matters in the long run. So now you mentioned the URA ETF, and there's also another one. There's the URNM ETF. It's a smaller one. That's a prod managed ETF for uranium. But then also we didn't really talk too much about. You said the mining stocks that have been, when it comes down to gold, for example, that the GDX and the GDXJ have been underperforming. SAL, SALJ have also been underperforming on the silver side. Do you think those ETFs still make sense, or is now the time to be picking individual stocks that are the most high quality and just sort of making your own ETF, if you will?
We do that too. We analyze in our gold silver subscription, which is very narrowly focused. Okay, it's not the. I suggest the all asset category where you look at all the big tectonic plates because they impact each other. When you just look at the miners, yeah, you want to look within the sector. It's true with any stock sector. There's always outperformers and underperformers. Beating the sector or not beating the sector, and they rotate. It's rare that you get a bull trend in a sector where during the entire bull trend, stock A always outperforms. Usually there's rotation within the process. So you might have one gold miner that is underperforming for a year, and then suddenly the next year it's outperforming the sector and so forth. So we look at that. We try to pick, a dozen or so that look like they're beating GDX, and we measure this on a spread basis. We don't just look at their silly price charts because that doesn't always tell you the truth. They all might be going up at the same time. The question is which are going up more, which have the technical dynamics based on their spread relationship to GDX, their relative performance relationship, technically speaking, to GDX, to sustain that. So, for example, the two big blue chips in the gold sector, Barrick Gold and Newmont, they vastly outperformed GDX up through about a year or so ago, and then suddenly vastly underperformed. Newmont collapsed basically. But now it looks like don't be shocked if you start to see basing action, not only by the stocks, which we're considered, they've already turned up as far as we're concerned. Last month's close on Newmont and Barrick flipped their intermediate trends back to positive. So the corrective process they were in since early this year, which for them was pretty serious, we think is over and you're now back to upside. That's not the point. The point is, at what point did they begin to actually outperform GDX in terms of percent gain? We try to measure that as well. And it wouldn't surprise us that happens soon as well. It's not happened yet. But instead, there's other miners within the sector that do outperform. But again, it's a constant process, month by month evaluation, because who's a relative performer now can suddenly become an underperformer, and you want to rotate to something else. So in general, for most investors, we suggest, without trying to be too nitpicking, just go with the sector. Go with GDX, go with SIL, instead of, fretting over which one here or there, because they're going to rotate. We noticed lately, for example, that SIL, which has been underperforming GDX, the silver miners versus GDX, which also contains some silver miners, but mainly gold. When you looked at the highs in price on GDX for the prior several months, GDX it was at the 30 level. GDX only broke through that a week ago. SIL broke through that several weeks ago, comparable level. So silver miners actually came up out of the hole better than gold miners recent upturn. So these things rotate. But as we said, there's a point on the GDX spread versus gold that we measure month by month that says, okay, GDX will get to a certain ratio, percentage of the price of gold. Its relative performance shifts back to positive to gold, which would indicate that if gold's going up more, GDX is going to go up more on a percentage basis. And we're at the cusp of that, but we're not quite there yet.
I don't know how much I've annoyed you by bringing up fundamentals every time, but I'll bring it up just one more time to try my luck. But with interest rates now being high, at least nominal interest rates being high. And so financing costs for the mining, CapEx intensive projects are much higher, as well as inflation is just causing CapEx growth in and of itself as well. While, for example, community relationships across the globe are worsening, while red tape is growing and so on and so forth, just making the environment in which gold miners operate more hostile. It almost makes sense for me that the miners have been underperforming gold. So do you think that something has to change fundamentally for it to happen, or is this another type of emotionally driven event that you think is going to move them?
Again, that same punishment, that interest rate cost factor, applies to all companies. Okay, not just gold miners. So, when you're looking at mining, or you're looking at companies to invest in, well, that's true with any company that has to borrow money. So it's not just true with gold miners. So yeah, it may be a negative for gold miners, but it's negative for everybody else borrowing money. Okay, so it sort of evens out in terms of what the main thing for the gold miners right now is a perception on the part of investors. Oh, gold's really going up. As if they needed more proof. Right now we're getting this turmoil to sell off the new high, and they sell it off, and you dust the gold market up and go back through tonight's high next week or something, and suddenly people say, this is for real. I need some miners because they're vastly cheap compared to that which they produce, and then suddenly their main profit issue is the price of gold, the price of silver, not so much the cost of money.
Well, a lemming never really jumps off the cliff. Most lemmings don't jump off the cliff on their own. So there's always that first one, and then the rest follow. So that's basically what you're describing here. So I can see that time is pushing for you. I only had scheduled 1.5 hours. So I don't want to take up all your. I can talk to you about these things all day. You're very, very easy to listen to. And you do a lot of these interviews, so you've probably been asked every question that I could think of, and then some. What haven't you been asked? What do you want to talk about that nobody ever asks you about?
Well, the main thing I'd like to bring up is the political issue that I brought up, because it's not on the tabletop, and it should be. And I think it will be especially in the first quarter of next year. I think it'll become more and more an issue. Like, hey, we've not priced this into our expectations of stability in the U.S. Government bond market illiquidity, stock prices, uncertainty, emotional consequences thereof, and gee, I want some stability in my life. What can I count on? What's at all-time new highs? Gold? So it's all these things come together, but I think that variable is the one that needs to be talked about more and more, and will be talked about. And you don't have to wait to the election to see the outcome. I think you'll see that wave of uncertainty hit the markets very soon. And we're already seeing it in the lingo, in the editorials I mentioned, where Trump's a dictator. There's a Washington Post editorial, and Liz Cheney saying we'll have a dictatorship if he's elected, and so forth and so on. And vice versa on the other side as well. So it isn't going to be comfy, and it's not priced into the markets.
All right. Well, it's definitely it seems like a unique time, I suppose, but this time is different. I've been told is our dangerous word to say, but when it really is different, there's a lot of money to be made. And so that's why these discussions are always so interesting to me. It is olivermsa.com/subscribe for the people watching this who want to.
Or you want to sample copies, to go to page where my picture, you see my picture, great picture. And below it's my email. Click on the email and ask for some sample copies. Be happy to send them to you.
Right. Okay. What are people getting? I'm looking at the prices over here. You have a bunch of reports that you have here. That's gold, silver, and mining report, which has been the topic here today. That's $300 a year. What are people getting if they get that report?
Every weekend you get about 2 reports a week, including the weekend report, which covers gold, silver, and the mining ETFs especially. And then usually about once a month, we have a sift report where we sift through the miners looking for outperformers. Not that we pick them all, but we try to pick a dozen or so of what we see as outperformers. And we measure that technically, not fundamentally. The 360 report is, again, the full spectrum. It includes what we just talked about, the gold, silver, so forth, but also commodities in general, foreign exchange, stock markets, and the bond markets. because frankly, if you're not looking at those other categories, you're looking at gold very narrowly and you're missing a lot. So we strongly suggest that, not just because we make more money off of you doing that, but because frankly, that is where you should be looking broadly, because we are not just in a unique place, we're in a historic place in time, I think.
Would you stop posting on Twitter, by the way? It was Oliver_MSA, but last time you posted was in 2022.
No, my son handles the Twitter page, and
Okay.
even though my name's up there, he comments every so often. I don't comment on there; he does for me. But anyway,
Well, bug him a little bit, because I can see here some of the last posts were from 2022, and they
no,
were
he's
good
done
posts.
some this year. No, I don't know why you see that. I'm sure he's
Okay.
done some this year.
Because I'm
Anyway,
looking at Oliver_MSA. Maybe that's a different account that he's moved on, so I got to check.
it could be. It could
I
be.
do like the Toyota that you
Or I
posted in
don't think
20.
he's on Twitter. Go to Oliver MSA, see if you can find it there.
Okay.
Okay. Anyway,
Yeah.
but sample reports are happy to send you a handful of sample reports so you could see the nature of our work and how we define technical analysis, because it's not normal. We don't just look at simple price charts and draw little trend lines and overlay moving averages. That's ineffective data as far as we're concerned.
Yeah.
We've been around for 30 years, primarily institutional subscribers and who pay for special research above and beyond what you see on the site. But it's based on the momentum structural analysis of price, not price itself.
Well, if people are having any doubts or anything, they should just look at, again, the Twitter profile and see that you bought a Toyota, where you say that you've also been driving
a couple
a
years
Volvo
ago.
before that.
Yeah.
So
I'm
apparently you know your cars.
Good. Yeah.
Yeah,
We're out in
apparently you know your
Colorado.
cars, and you're also long-term focused, because that Toyota is probably, it's just going to go on forever if you give it enough love. So good purchase. I like it.
Okay.
All right, Michael, thank you so much for
Thank you,
investing your
Antonio.
time with me today. It was a good
Thank you.
talk.